Let me tell you a fun fact. Within the last 2 centuries, more than 90% of the world's millionaires have been created by investing in real estate. But if done incorrectly, without the right knowledge, required skills, or partners, it can also create a ton of problems and a lot of sleepless nights. You feel like sometimes there are way too many gurus out there trying to sell you on a weekend course, or just too much noise to cut right to the facts? Yup, we did too, and this is why we started this podcast. Our goal is to provide real estate investors, entrepreneurs, and enthusiasts with all of the most recent knowledge, secrets, tips, tricks, and tactics so that you can grow your own portfolios, increase your returns, net worth, and most importantly, create generational wealth for you and your loved ones. Remember, this is your real estate career. Information is your sword and shield, so eat hearty, prepare for battle, and grind your way to victory. My name is Tejas Gosai. I'm joined by my partner, Jeremy Moyer, and we welcome you to the Real Estate Investor MBA podcast.
Hey everyone, welcome back to the Real Estate Investor MBA. This is Jeremy Moyer. We had a really good interview that we just came out of. We had Brandon Hall from the Real Estate CPA firm. Brandon provided a ton of really good information. So that the main topic today was how to qualify as a real estate professional for landlords. I think there's a lot of misconceptions, or there's a lot of conflicting information out there. So we wanted to bring an expert on who was well versed in this topic to kind of break it down for us. So, he really goes over the why you want to qualify for this, what are the benefits from it, and then really what are the nuanced steps and test thresholds really that you need to meet to qualify as a real estate professional for landlords from the IRS's eyes and the tax code. So I learned actually quite a bit from the just talking with Brandon for the time that we had together. So I think you're really going to enjoy it. So enjoy and let me know what you think. Hello, everyone. Welcome back to the Real Estate Investor MBA. My name is Jeremy Moyer, one of your hosts. By myself today, as my co-host Tejas Kasai is not able to be here. Please check out our website, realestateinvestormba.com, where you can find all of the interviews from our prior guests. A lot of great content's been shared over the past year or so. A reminder, we are available on several podcast platforms: iTunes, Stitcher, Spotify, Google Podcasts, iHeartRadio, and TuneIn. We're also on Facebook and LinkedIn. You definitely got to check us out. Look at all our past episodes, subscribe. If you think we're providing value, please give us a 5-star review. Leave us some feedback. We love to receive feedback from our listeners, suggestions for upcoming guests, topics to cover. All that is great to receive. So now on to the interview for today. I'm excited to announce our guest for today, Brandon Hall. Brandon, how you doing?
Good. Thank you so much for having me on. I appreciate it.
Absolutely. So Brandon is a managing partner at the Real Estate CPA, and he's also a real estate investor. His area of focus is tax planning. His firm prides themselves on working with only real estate investors and business owners. He has a bachelor's of science degree in accounting and finance from Eastern Carolina University and has worked for Price Waterhouse and Ernst & Young in the past. Brandon, thanks again for your time this morning to talk.
Yeah, no, I appreciate it. It's a good intro.
Absolutely. That's perfect. So before we kind of get into the main topic today, can you tell our listeners a little bit more about how you started in real estate investing and also what drew you to accounting and tax planning?
Yeah, so when I was in college, I doubled in accounting and finance and just ended up going the accounting route. Landed the job with PricewaterhouseCoopers out of college, but probably 3 months into that, realized this was not for me. And I'd always kind of been like a little bit more entrepreneurial. I'd tried businesses when I was a teenager and in college, had zero success with them, but tried them nonetheless. And kind of got into the real world and realized, I don't want to sit around for 15 years to make partner to make 300 or 400K or whatever. I felt like I could do it faster. I felt like my opinion wasn't heard or valued, and so I launched my own firm while I was still working a full time job. So there was a period of time where I was probably working 100-hour weeks for quite a while. But through that entire process, I found real estate. So I found biggerpockets.com, and I was asking my own real estate questions because before I decided to launch a firm, I was like, I'll just invest in real estate and I'll create this financial freedom. So I bought a 3 unit property while I was still at the big four working, and it was cash flowing $700 a month. So I mean, it was a pretty sweet deal. But I started, like, crunching some numbers and realized that this thing was gonna I would have to buy like 10 more of these to replace my day job income. And by the time that I replaced 10 more, or by the time that I replaced it, I probably wouldn't replace it. I had to buy another 10 more to really replace it. And the math just wasn't adding up for me. So it was slower. I love real estate investing. I've got 25 properties now, but it's a much slower starting process. So I wanted something faster. So I launched my own firm and I targeted real estate investors. I was in this space at that point, and the rest is history.
That's tremendous. Yeah, absolutely. I think when you start out, sometimes the excitement, you buy your first couple properties and then the numbers start hitting you and you're like, wow, this is going to take a while. But
Yeah,
that's okay. I mean, real estate's it's a wealth game, right? It's a long-term wealth game. It's not
yeah.
a get rich quick type of thing. Yeah.
And I should say too that I've never been on the side of let me do this full time. Let me do real estate full time and like find great deals. So we have clients that are able to make it happen real quick, but you have to dedicate a lot of time to it, to educating yourself, finding the deals, analyzing the deals, and ultimately negotiating the deals and making sure that you're getting a good deal. I wasn't going to do that because I was working at Ernst and Young full time at the time. And then but what I looked at was, all right, what is something that I can run that's extremely scalable.
Mhm.
And that was a business over real estate. So I went the business route, but invest in real estate on the side to continue to compound that wealth.
No, that's tremendous. And I think it's an important aspect that sometimes people don't think about. You have so much time in your day, and really, where can you leverage your time the best, and then leverage other people's time, through passively investing in real estate, right? So it's
Hmm.
it's huge. Awesome. Well, thanks for that, Brandon. So for today, we'll be covering a specific question. Really, it's how to qualify as a real estate professional, or in the real estate profession, for landlords. I think it's a very important topic to understand if you're either passively or actively investing in real estate. There can be some conflicting data out there. I know I've heard different things here and there. And, I wanted to bring Brandon on, who's an expert in the field of taxes and how they relate to real estate investors, to help explain this for our listeners. So, Brandon, can you start off explaining the basis of why someone would want to qualify as a real estate professional, and what's the importance of that?
Yeah. So when you invest in rental real estate, you like when you acquire rental real estate, that rental real estate is going to typically produce a tax loss, even though it produces positive operating income. So my property that generates $700 a month in cash flow, even though that's $700 a month that's hitting my pocket, it's cold hard cash. I can take to the grocery store and buy things with it. I'm telling the IRS that I actually lost money on the property. And the reason for that discrepancy is something called depreciation, which just tracks the deterioration of your building over time. And most people say, well, real estate appreciates, so why would you have depreciation? It's true. The value of real estate goes up over time, but the building itself literally falls apart. So that is what depreciation is meant to track. It's an annual credit that you get to claim. I shouldn't say credit, but deduction, but it's an annual deduction that you get to claim on your tax returns, and you get to offset whatever net income you've generated from your rental real estate. So oftentimes depreciation will kick landlords into a negative tax situation, meaning that their rentals will show on their tax returns that they've generated tax losses, even though they're positive cash flow. So the next question becomes, well, what do we do with those tax losses? Can we use those tax losses, or how can we use those tax losses? Because the issue is that rental real estate by default is considered passive income. And every single dollar that you earn goes into one of two buckets. It goes into the passive income bucket, or it goes into the non-passive income bucket. Every single dollar that you earn. So your W-2 income, your business income, interest, dividends, gain on stock sale, all of that goes into the non-passive bucket. What goes into my passive bucket is all of my rental real estate and any trade or business that I don't materially participate in. So if I were to go place, $100,000 investment into the local hair salon that's expanding and they're going to pass $10,000 back to me every single year. I don't have voting rights. I don't make management decisions. I'm not participating in the day-to-day business. I'm passively involved in that hair salon. That $10,000 a year that I receive is going to be considered passive income, most likely. So in my passive bucket is all rentals and any trade or business that I do not materially participate in. The problem is that my rentals, we just told you that tax loss that your rentals generate are in that passive bucket. The problem with that is that passive losses can only offset passive income or gain on sale from passive activities. So what happens with landlords is I'll buy this $100,000 property. I'll have $2,000 of tax losses from the property, even though I had positive cash flow. After I take depreciation, I have a $2,000 tax loss. That's what I report on my Schedule E. New landlords getting into real estate think, oh, I just get to use that $2,000 to offset my W-2 income. And that is not how it works, because your W-2 income is in your non-passive bucket. And that $2,000 tax loss is in the passive bucket. And if you don't have any other passive income or gain on sale from a passive activity, that $2,000 is going to be suspended and carried forward. So next year, your beginning passive losses that have been suspended and carried forward is $2,000. And you just keep carrying it forward and carrying it forward and carrying it forward until you die. So that's the problem. We don't want to see landlords get a ton of or a high value of suspended passive losses carrying forward. So if you went out and bought 10 properties, let's say you 10x that, now you're talking about $20,000 of suspended passive losses that you're carrying forward. And now that tax savings that you could have otherwise had starts to add up, because if you had $20,000 that you were able to offset your W-2 income with, if I'm able to write my W-2 income by $20,000, I'm probably going to save $6,000 between federal and state. So I want to try to figure out how to unlock the $20,000 or unlock any suspended passive losses from my rental real estate. I want to figure out how to move my passive losses from that passive bucket and into the non-passive bucket. And real estate professional status is one of the ways to do that. So if you qualify as a real estate professional, you can count your rental losses as non-passive. So you move them out of that passive bucket and into the non-passive bucket. And now you can claim that $20,000 loss against your W-2 income. If you don't qualify as a real estate professional, and if you don't meet one of the other two exceptions to this rule, then those passive losses will be suspended. You won't be able to use them today.
Yeah, that's a tremendous explanation. I think visually thinking about the different silos, right, of income, like the nature of how if it's active, it's passive, and the different buckets as you were explaining. And I was having this picture in my mind of kind of how all that was structured. Because if not picturing like that, it's kind of just everything's minutia. It's all mixed together, right? At least in my head.
Yeah.
Um, you mentioned, I was going to ask about exemptions, and you mentioned some exemptions. If you don't qualify as a real estate professional, what are those exemptions? Is it income level exempt? Is that what it is? And if it is, what are those levels?
Yeah, so there's two additional exemptions to these rules. The first is that if you sell a passive activity at a gain, then any passive losses from any other passive activity can be used to offset the gain. Now, a lot of CPAs, sometimes we run into CPAs that say, no, your passive losses from your rental can't offset the gain from your syndication, or vice versa. The losses from your syndication investment you just made can't offset the rental income from your other rentals, or the syndication investment that you just made can't offset the $10,000 of profit that I'm receiving from my hair salon every year. But that's not true. And if any CPA ever tells you that, ask them to prepare a Form 8582. And they will quickly find that all passive activities can net out against each other. And that's important because this exemption that I'm telling you about, whenever I sell any passive activity, any type of passive activity, if there's a gain, it's going to flow through to Form 8582, and I'm going to be able to use passive losses to offset that gain. So very helpful for landlords who maybe you can't meet the 1031 exchange requirements. Maybe you bought a property in January and now you want to sell another property in November. Uh, well, the property that you sell in November, you can offset that with like a cost segregation study and bonus depreciation from the property that you bought in January. So we're effectively doing a 1031 exchange without doing a 1031 exchange. The really important concept to understand that when I sell one rental, my other rental losses can offset it, or I can buy new rentals and create rental losses to offset it through a cost segregation study and bonus depreciation. So that's one exemption. The other exemption is the $25,000 passive loss allowance. If you earn less than $100,000, you can claim up to a $25,000 passive loss allowance as long as you actively participate in the management of the activity and as long as you own at least 10% of the activity. So you can't do this with syndication investments, but you can certainly do this on your own rentals that you own. Now, if you earn above 100, the $25,000 allowance phases out. So it's totally phased out once you reach $150,000. But the way the phase out works is it phases out $2 for every $1 your income is above 100K. So if my income goes to $100,001, my passive activity loss allowance is now 24,998. And this is important to understand because sometimes we run into clients that say, "Oh, I'm gonna contribute extra to my 401k and I'm gonna drop my income to $149,000." Well, if you drop your income to $149,000, you only have a $500 passive activity loss allowance to use. You don't get the full $25,000 because most of it's already been phased out. So that's an important concept to understand too. And I think I might have actually said my two for every one backwards, but hopefully the latter example you get the point.
So, how do you actually qualify as a real estate professional? What are the requirements in the code?
Yeah, but before I give you these requirements, I just want to say the whole like suspended passive loss thing that we were talking about a few minutes ago. Some people say, well, I'm not going to bonus depreciate, or it's not that big of a deal. I'll just take my depreciation annually and I don't really care about the suspended passive losses. And sometimes you can't do anything about the suspended passive losses, right? They're just going to accrue. But ideally, we claim them today. And ideally, we bonus depreciate our properties today because of the time value of money theory. The time value of money theory says that a dollar today is worth more than a dollar tomorrow, right? If I have a cold hard dollar in my pocket and I go to the grocery store and I see a half gallon of milk for $1, and for whatever reason I decide not to buy that half gallon of milk, I stuff the dollar bill back into my pocket. A year goes by, I've washed my jeans many times, and now I go back to the store because now I do want to go buy that half gallon of milk. I reach into my pocket. Oh, sure enough, there's that $1 bill. But now I look and that half gallon of milk's $1.03. What happened? Well, the cost of goods increased over time. So in reality, that dollar has lost value. So the time value of money theory says a dollar today is worth more than a dollar tomorrow, which is true. But you can also apply that to your tax savings. A tax saved dollar is worth more today than it is in the future. So whenever people are coming to me like, oh, well, I think I'm going to spread my depreciation out, or I don't want the recapture on the back end and all this other stuff. I'm like, you're missing the point of just basic economic theory of making sure that you optimize every single dollar today. So that's why this discussion is so important. This real estate professional discussion is so important because if you can qualify as a real estate professional, you will optimize your tax loss dollars every single year. And it's really, really important to understand that. Now, how do you qualify as a real estate professional? You have to spend 750 hours in a real property trade or business, and you have to spend more time in real property trades or businesses than you do anywhere else. So you have to meet those two tests. Now, that latter test, the more time in real property trades or businesses than anywhere else, it's going to kick out anybody that has a full-time W-2 job. Why? Because you got to spend more time in real estate than you do in your W-2 job. So if you work 2,000 hours a year, you're talking about an additional 2,001 hours in real estate. It's not going to happen. And even if it does happen, the tax court's not going to buy it. So that's the other thing that you have to think about too. Because a lot of our new clients come to us and they're like, they have this idea in their mind of how they're going to, qualify for real estate professional and substantiate everything. And then we look at it and we say, hey, that's great that you think that you can spend 2001 hours in real estate and 2000 hours at your W-2 job. Heck, I think you can do it too, because I've worked the 100-hour weeks. I get it. You can do it. You can for sure do it. The problem is the tax court's not going to buy it. That's the problem, right? You have to convince the tax court, because at the end of the day, if you get audited for this, and you probably will if you have a full-time job and you're claiming this, you're going to get audited. The auditor is definitely not going to buy it. You're going to try to appeal the audit, and they're going to say, too bad, take us to court. So then you have to go and convince the judge, the tax court judge. And that's going to be a really tall task. Nobody's done it to date. So you would be the first if you can do it. So you have to spend more time in real estate than you do anywhere else. If you're working a part-time job, 1,000 hours a year, you can do this, right? The tax people have won in tax court on part-time jobs. More time in real estate than anywhere else. But that first test was 750 hours. It's kind of your basic, you have to have a minimum hour requirement, and then you also have to spend more time than you do anywhere else. That's just step one, right? So if I'm a real estate professional, for tax purposes, I work the 750 hours. I spend more time in real estate than I do anywhere else. I'm a real estate professional. My rental activities are not necessarily non-passive. I also have to show that I materially participated in my rental activities, and that's a separate set of tests. There's 7 tests for material participation. The 3 that we see most often are that you spend substantially, or your participation is substantially all the participation in the activity. That's test number 1. What does that mean? I self-manage. Nobody else touches it. My participation is substantially all the participation. The second test is I spend 100 hours and more than anyone else. I'm going in order of least number of hours to great number of hours here. So substantially all. Second test, 100 hours and more than anyone else. So I have to outwork everybody else, and I have to spend at least 100 hours. Third test, 500 hours. So if I spend 500 hours of my rental activities, I'm good to go. I can group my rental activities together for the purposes of these tests. If I don't do that grouping, I have to look at these tests on a property by property basis. So if I have 10 properties, I have to look at each one of those and apply those tests that I just outlined for you. And if I don't want to do that, I can make an election to group all the properties together, and then I can use the 500-hour test for my entire portfolio, which most people do. But the problem that people forget about here is that you do have to meet one of those 3 tests on your rental activities. And here's why. I can be a real estate professional by being a real estate agent. So that's 750 hours in the spend more time in real estate than anywhere else. It's not just landlords. There's 11 real property trades or businesses. So I can be a real estate agent. I can be a developer, a redeveloper, flipper, wholesaler. I can be a whole bunch of different things. Or I could be a property manager or a landlord. So if I'm a real estate agent full time, I spend 2,000 hours a year being a real estate agent. I'm going to hit the 750-hour test, and I'm going to hit the more time in real estate than anywhere else, because it's all I did. I'm a real estate professional as a result. But if I don't also go and materially participate in my expansive real estate portfolio, then all of my rentals are still passive. So even if I'm a real estate professional, I have to go and materially participate in my rentals. Now, some of our clients are landlords full time. So they hit real estate professional status, and they also hit that 500-hour material participation test on their rentals. 2 birds, 1 stone, you're good to go. But a lot of people forget that they have to also materially participate in the rental activities. And it would really stink, because you go to tax time, you think you're a real estate professional, only to find out that you're not, and that your rentals are still passive and the losses are passive. So if you can qualify as a real estate professional, and if you can show that you materially participated in your rental activities, then you've successfully moved your rental activities out of that passive bucket and into that non-passive bucket. And now you can juice the bonus depreciation with cost segregation studies and things like that to increase your tax loss and offset all of your other income.
Interesting. I wasn't aware of. I just thought realtors and brokers, they were automatically, grouped into that. That's interesting. I didn't know that. So do you have to?
They are. I mean, they are automatically a real estate professional, right? But the
Right.
agents, those are the folks that we typically have this problem with,
Mhm.
because they forget to also go and materially participate in their rentals.
Interesting. So do you have to pass all the tests to be classified as a real estate professional that you just explained, or
Good
three of the
question.
seven, or
Good question. So for the real estate professional status test, it's 750 hours and more than anyone else. So you do have to pass both of those. Or sorry, not more than anyone else, more than anything else. So you do have to pass both of those. For material participation, there's 7 tests. I outlined 3 of them, substantially all 100 and more than anyone else, or 500 hours. You only have to pass one of those tests on your rentals. So sometimes with agents, what we'll actually see is they'll qualify as a real estate professional just through their day job of brokering deals, and then they'll self-manage their rentals. And because you're self-managing your rentals, most likely your participation is going to be substantially all of the participation in the activity. But you should always obviously touch base with the tax advisor before claiming that tax position.
so does that, the one that you just mentioned, all activities, like you don't have a partner? Is that what that means? That is helping out with managing
Right.
the properties? Is that what that means?
Yeah. Substantially all means that you're basically you are self-managing the thing. You're even probably doing some of your repairs yourself.
Gotcha.
There's not a whole lot of other people really touching the property throughout the year. And the nice thing about the substantially all test is that in theory, this is theory, in theory, you can work like 40 hours a year on your rental and it can be considered non passive because you've already qualified as a real estate professional, as a real estate agent. So, in
Mhm.
theory, it's an easier threshold to achieve versus, compare that to your 500-hour test. That's a lot of time. It's a lot of time.
Right. Okay. You touched upon a term that was materially participating. I'm sure the IRS has a unique definition to that. Or like what activities qualify under that participation? Like, can driving to go find new properties, or do you have to? It's the properties that you currently own. Could you clarify that?
Yeah, so you actually just you're teeing me up here. This is great. So 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 when we have this talk with clients, with new clients, the next question is exactly that. Well, what counts for material participation? Because if you've heard, all right, there's a quantitative there's a quantitative hour test, not only for material participation, but also for real estate professional status. So what's the qualitative piece? What hours are going to count towards that 750-hour test for real estate professional status and towards my substantially all 100 hours more than anyone else or 500-hour tests for material participation. And this is where this is where we kind of kill some dreams, okay? Because a lot of people, um, look, you want to hear that the easy things count, right? I want to hear that if I'm trying to go for real estate professional status and material participation, I want to be told that my time looking on realtor.com for new properties counts. My time analyzing 300 deals a week counts. My time driving to my property that's 2 hours away from my home counts. My time looking at the property management statements that the property manager gives me counts. My time on the phone with the property manager counts. Unfortunately, none of that time counts. Okay,
Wow.
so
Yep.
the time that does not count. It's easier to talk about the time that does not count. The time that does not count for real estate professional status or for material participation is any research time, any education time. Travel time will not count in most cases. If you are traveling locally to your property on an ongoing basis, that is where there's still gray area. There was a tax court case, Lay versus Commissioner, where the taxpayer won on the travel time because all the properties were local to the taxpayer and they were self-managing. So
Mm.
potentially allowed to count travel time, but research time, education time is not going to count. Travel time is not going to count. And investor level time is not going to count. What is investor level time? It's my due diligence, the analysis that I do up front. It's looking at the property management's report every month whenever they send it to me. It's paying my bills. It's
Mm.
filing tax returns. It's talking to my CPA, talking to my mortgage broker, talking to my attorney. All of that is investor time. Why is it investor time? Because that's what an investor would do when they buy property. So that time's not going to count unless you are involved in the day-to-day management of the activity. So if you are self-managing this thing, if you are involved in the day-to-day management of running your rental portfolio business, meaning that it's expansive and you might have property managers, but you're doing it basically full time. Cool, your investor time counts. Investor time is not going to count when when I have a portfolio of 10 properties or lower, or there's no magic number to this, but it's not going to count when I'm like investing out of state or a couple hours away and I've got a property management on it and I never visit the property and I just briefly touch base with the property manager once a month. That's investor level time. That's not going to count for real estate professional status. It's not going to count for material participation. Sometimes people go, well, what if I manage my property manager? Also investor level time. Not going to count unless you're involved in the day to day management of your activity. So, what time does count? Well, if you didn't have a property manager, think about all the things that you would have to do to run the property. That
Mhm.
time counts. So advertising for tenants, coordinating with tenants, coordinating leases, coordinating contractors to come and fix up the property or whatever. Whenever things break, managing the property, collecting rent, paying bills, all that stuff. When you're managing the property on a day-to-day basis, that's the time that counts for real estate professional status and for material participation. So what we often run into with our agents, our flippers, our builders, they qualify as a real estate professional through their main trade, right?
Mhm.
But then they don't want to go and self-manage the property. So they have a property manager on their rentals, and their property manager is the one that's materially participating in their rentals. They're not going to materially participate because they're just overseeing it. And that's just investor level time. And investor level time doesn't count unless you are involved in the day-to-day management of the operations of the rentals.
Wow, that's thanks for breaking that down. So it's
Sure.
what I'm hearing is it's if you do have a property manager, it's almost extremely very difficult to qualify the status.
Yeah, it's the first thing the
Agree with that?
IRS is going to ask for. Well, one of the first things the IRS is going to ask for is your property management agreement.
Mm,
And if you have a property manager that's in that agreement says they're doing everything, you're going to lose. You're going to lose.
mm, tremendous.
Yeah.
That's great. So you have clients that come to you and they actually have a shot at qualifying for this status. Do you advise them on documentation techniques or software to use? Like what is advisable? I mean, write it down in a notepad, an Excel sheet, or actual like software to log your time, your activity. What are like best practices?
Great question. Yes, so we actually spend a lot of time whenever we do any sort of real estate professional status analysis. It's always like, first, can you qualify? Two, track your time for a little bit. We'll see if you actually qualified. Then three, all right, let's substantiate everything now, because when you get audited in 3 years, it'd be great if that audit was super smooth and you
Yep.
won. So to substantiate real estate professional status, you need to record your time, not just your real estate time. You need to record all of your time, your time spent working in your business, time spent working your W-2 job, time spent at like civic hobbies and duties and things like that. Like if you're doing a lot of volunteer work or you're on the PTA committee for your kids at school, or PTO, whatever it's called at school, you've got to log that time too if it's taking up a significant amount of time. Because what's going to happen is the auditor, the IRS auditor, is going to make assumptions about all of this time unless you record it and document it for them. Okay. So they're going to make assumptions like, oh, well, based on my experience going to my or in being involved in this XYZ volunteer activity takes up way too much time. And there's no way that you could also have enough time to manage your rentals. Right. So they're going to make those assumptions. So you have to document all of your time. I recommend doing a Google spreadsheet. You could put it on your phone, right? So it could be on your iPhone or Android. That's what's nice about G Sheets. But you need the date, the date of the log of the time log that you're about to enter, the date of the input, the date, the property that the property that that's related to, the description of the work performed, and I think that's about it. Date, property, description of the work performed. That should be how much time you spent. I was
Right.
missing the most important piece. How much time you spent. So date, how much time you spent, description of the property, and description of the work performed. In the description of the work performed, do not just say emails. Do not just say repairs. We don't take tax. We don't take the real estate professional status tax position. We will not claim on anybody's tax return unless they provide us with a time log that is well built out. And we get time logs all the time where somebody just typed like emails into their G sheets and just drags it down, you know? So now everything's emails. But the problem is 3 years from now, when and if you get audited, or if and when you get audited, you have to go back to like specific entries and know exactly what happened on those emails. What emails are you referring to? What
Mhm.
repairs did you actually do? Because they're going to want to look for Home Depot receipts and Lowe's Home Improvement receipts on the same day that you say repairs. So give yourself enough context now so that your 3 year older self is going to thank you. And so we recommend being as detailed as possible. You don't need to write a freaking novel, but more than a handful of words would be good. Like think about every single note, every single description of the activity for every single entry. You need to have a tweet, a tweet length note
Yeah.
that reminds you of what happened, what went on. And it shouldn't be the same as all your other notes unless you're literally doing the same job over and over and over again, which most people don't.
Right. No, that's helpful. So, and then in that sheet, they should also have, like you mentioned before, if they do charity work, like they should almost like fill in spaces in between
Hmm.
the real estate activity as well, right?
Yeah, yeah. I mean, if you don't have any of those other activities, you don't need to worry about it. But if you've got,
Okay. Yeah.
if you have commitments that take up a significant amount of time, I'm not talking about like a once a week meeting
Sure.
or something like that. But if you've got commitments that take up a pretty significant amount of time of your week, you need to document them because the IRS, when they audit you, they're going to find out that you've got that commitment, and then they're going to make assumptions about how much time it actually takes. So it would be great if you could head off those assumptions by documenting yourself and presenting that as evidence whenever you do get audited.
Okay. The greater transparency, the better
Yeah.
in this. Yeah, that makes sense. So claiming this, the real estate professional status on your tax return, is it a red flag to auditors? Like they see this and most likely you will be audited at some point. Especially, like you mentioned, if you have a W-2, you will.
Yeah.
But if you have your own business or it's full-time real estate, is do you see them being audited more often or
It's tough to say. I mean, there's no real data to point to, so I couldn't
sure.
give you anything concrete, and neither could anybody else. Um,
Okay.
how the IRS audits though is they run your return through a computer program, and it compares it to all the other hundreds of thousands of tax returns that have similar that
Mm,
look and feel similar to yours. So
okay.
if you are if you have a W-2 job and you go and claim real estate professional status, well, how many other Americans with W-2 jobs are claiming real estate professional status? Not
Mm,
many. So the theory goes your chances of audit just went way up because you have the outlier tax return. So you just need to be ready to rock and roll. Now, if you're in real estate full time and you're claiming real estate professional status, that return probably looks pretty similar to everybody else that's in real estate. If you're running a business that's separate to real estate, and you're claiming real estate professional status, then there you go. Again, you've got this return that's more of the outlier than it is the norm. And so whenever you have returns that are going to be the outlier, you just got to be ready for an IRS audit, and you have to start substantiating everything today, so that again your 3 year older self
yep.
will thank you.
Interesting. Okay, I wasn't actually aware of the what you just described. How they look at the average base, if you want to call it that, type of return in
Mhm.
your situation. So that's interesting. Okay, that
And
makes
I
sense.
will say on the audit note, real quick, that in our experience with audits, we've been involved in a handful
Mhm.
on real estate professional status specifically. In our experience with this, the people that get roughed up, um, roughed up in the kindest sense, but the people that get roughed up in these audits and that lose, they don't have time logs, or they've built it out retroactively, or it's junky. Like I just said, it's just like emails, 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 emails for every single entry, or repairs, or repairs, or repairs. The people that have no change audits, meaning that they win essentially whatever return we filed for them is the good return.
Mhm.
and that the IRS agrees with that. The people that have no change audits are the ones that are very detailed with their time log. Because think about it, you submit the IRS is not in the business of trying to waste taxpayer money on getting you right. They
Right.
want to spend taxpayer money wisely, and they need a return on that investment. And so they're going to go after the people. I mean, they're going to randomly audit everybody, but they're going to pursue the people that they know they're going to win on, right?
Mhm.
If you present a time log that's bulletproof, they're going to, I don't want to say let you off, but it's going to be a pretty easy ride.
Right. Yeah, we're not gonna dig in further. Yeah, yeah,
Yeah,
that makes sense.
I should say relatively easy because everybody hates audits. No audit is fun, but
Sure,
relatively speaking, it's an easier ride if you develop this spreadsheet out.
perfect. Okay. So I think you kinda explained this in the beginning, when you were talking. I just wanted to ask this specific scenario to get, like, paint an example and just to understand it. So you have a working professional, makes $200,000 gross, adjusted gross income. They invest passively or maybe actively in real estate, um, either in a single asset syndication, or they buy their own rental properties, but they use a property manager. They spend very little time, actually managing the day to day. They review monthly reports with their manager. Um, they show yearly losses passively, even though money is actually coming in from the cash flow. If they're not able to qualify as a real estate professional, which most likely they won't in this scenario, they can carry those passive losses forward,
Mhm.
right? And then upon the sale of those assets, then the capital gains they can deduct, not deduct, but their losses will go against those capital gains. Is that how that works?
Yes. So if they were to sell the real estate at some future point,
Yep.
the losses that they have accrued over
Yep.
time, those suspended passive losses will offset gain from passive activities upon sale.
Perfect. Okay. I just wanted to make sure I had that picture in my head accurately, so I appreciate that.
Yeah. Yeah.
So Brandon, that kind of wraps up all the, I guess you can say, technical questions that I had outlined before we started this. Is there anything that I missed that would be good to mention or cover, or do you think we kind of hit all the big things?
No, yeah. I mean, I think that for anybody listening, this is the beginning of your journey to learn about real estate professional status. It's a lot more nuanced and a lot deeper than what we've covered here today.
Hmm.
We have a 12,000 word guide on
Hmm.
real estate professional status that is free to the public, and that's on our website, therealestatecpa.com. So you can go check that out, and if you want to learn more and really want, I mean, if you read that guide, you're going to be like top 1% knowledgeable in the United States. I promise you. It's fully cited out, all the tax court cases, all the code citations, and talks about everything that you need to know about real estate professional status. So if you're interested in learning more, or interested in holding your own CPA accountable to good advice, go check that guide out.
That's awesome, and we'll put that in the show notes for everybody. So Brandon, I'll get that
Cool.
specific link from you
Okay.
after the show. We'll put that there for everybody to download. I think that's tremendous that you provide that. So in closing, Brandon, I mean, the best way to get a hold of you is just to go to your website that you
That's
that
right.
you just mentioned. Is that the best way?
Yep. Yep.
Okay,
www.therealestatecpa.com.
perfect, awesome. Well, Brandon, once again, thanks so much for your time. It was a pleasure having you on. I learned quite a bit just asking you some questions and receiving the feedback that you provided. I'm sure the listeners appreciate that as well.
Yeah. Thanks for having me on. I've really enjoyed it.
Absolutely. So, everyone, this is Brandon Hall. I'm Jeremy Moyer with Real Estate Investor MBA. Please tune in with us next time. Appreciate it. Thank you.